Good afternoon. Welcome to Real Estate Raw. This is Bill Ham. Today we're going to be talking about multifamily loan maturities in this year, 2024, and over the next several years. So, always like to remind everyone, please tell us who you are, where you're from, whether you're watching this live or in the future. Post in here, say hi, and tell us what city you're from. Everybody always likes to network, and a lot of times people are looking for boots on the ground, so make sure you say hi. Today we're going to be discussing multifamily debt maturity in 2024 and going forward, and that's going to be the topic. All right, so it's a big topic. A lot of loan maturities coming up, and we also have a lot of loan maturities over the next 3 years. So I'm also going to talk about the 5 main cities with the largest volume of debt maturity. I posted this already, an article about this already, so you guys can go check it out, but I'm going to kind of go over it today, and we'll talk about what does that mean. Everybody say hi. I want to introduce Monica Wyndham. She should be joining us here shortly. Monica also helps run the program here and maintains everything in the background. So she's also excellent asset manager and property manager. If anybody has any asset property management questions, this is a great place to ask. All right, for the recording. So today we're going to be talking about multifamily debt maturity in 2024, extending out through maybe 2029 or so. So I want to start the conversation off with the 5 top cities, for multifamily debt maturity right now. Atlanta is leading the way, 34.9 billion in debt maturity through 2029. So I'm going to go through the list, and this list is from today through 2029. So Atlanta, 34.9 billion. We got Dallas, runner up, 26.5 billion. Denver, 22.9. We got Houston, 20.8. New York City, a little surprising there, 19.9 billion. And then lastly, Chicago. So those are your top 5 major metros for debt maturity: Atlanta, Dallas, Denver, Houston, New York, and Chicago, in that order. Is anybody in those cities? Tell me. Are you in those cities right now? Do you own in those cities? Are you trying to buy in those cities? I'd like to know. So what we have going forward now is opportunity and threat, okay? And it's going to be double-edged here. So starting off, if you're already an owner and you have loan maturity in 2024 or maybe in 2025, let's talk about that for a second, and then we'll talk about the opportunity side. If you're currently an owner, you got to focus on operations, right? If your loan is coming due in the next, say, year, few months, all the way out to the next year or two, focus on your operations. The lenders are going to be motivated to work with you, right? Right now, there's a lot of people that have loan maturities, and I've always said I don't mind having a problem as long as everybody else has the same problem, right? It's just when I'm alone with the problem that I don't like that. People would then come get you. Well, right now, if you have a loan maturing and maybe your numbers are not great in 2024, maybe 2025, you are not alone, right? We have a lot of loan maturing, a lot of people in that situation. So my tip here, and for all of my asset management clients, what I'm telling everybody is focus on your operations, right? Keep it clean. Keep it, don't over renovate, safe, clean, affordable. That's what I tell everybody: safe, clean, affordable. You just want to get the property together. Keep your expenses under control. Don't go doing renovations. Don't do large capex if you can help it. You've got to focus on marketing, get heads in beds. Don't run long-term concessions right now. You want to run short-term concessions if you're going to run concessions at all. Reason being, it's better to give away 1 month up front than to, say, lower the rent over an extended period of time. Renters are going to do this. They're going to say, hey, instead of a 1 month free rent, why don't you just take $100 or $200 off the rent for the year? And you might be thinking, well, it's the same bottom line, same end result, but it is not, right? Because once you go to raise the rents in the future, you're now raising rents from the lowered rent amount. And when you go, a buyer or someone else looks at your books, it's better to have that short-term concession that the buyer can discount and say, well, they've already, passed that time period, as opposed to a long-term concession where you've lowered the rents. So right now, focus on marketing, focus on making your units clean, safe, affordable. It's not the time to be trying to raise rents a lot. Get people in there, get your operations together. If you need help, call me, call Monica, call some sort of asset manager that can come in and help you straighten this out. The tip here, the idea is that you want to be the smallest problem in the room. Remember, you're not alone. The bank has lots of loan maturities. And they're going to start looking at different aspects of these loans. Okay, they're going to first off, they're going to say who is a good operator, who's a bad operator, right? If they believe that you are not a good operator or that this loan is no longer safe in your hands, it's not really going to matter about the interest rate and recapitalization, this kind of stuff. They're going to be a lot more likely to just move, be done with you, take the loss and write it off. If they believe that you're a good operator, it is just circumstantial due to the market, then they're a lot more likely to work with you over time. So that's how you're going to prove it to them. Get your books together, get your occupancy together, make sure your reporting is clean and professional. As Monica specializes in her company, getting software together for people. You want to really make sure that you have your software all together, the reports are clean, things of that nature. So big tip there, make sure you've got your financial house in order. So that's kind of what I would suggest if you have a loan coming due in the near future. Second suggestion, consider listing the asset. It's free to list. I'm not suggesting that you go out and waste a realtor's time, but I am suggesting that getting in touch with a realtor, getting their opinion of the asset, and perhaps putting that on the market and letting the market speak is free. So it's always worth just finding out what your property's worth. Who knows? You might get lucky. You might be able to sell the asset and pay the loan off and just run away to fight another day, right? So that's my second tip there, is you might want to go and look at selling a property. All right, loan maturity in these top 5 markets. Going to be a bit of a weakness in the sense that it's going to suppress lending in some of those markets. Okay, first off, Fannie, Freddie. This is where you are likely to see the first decline in some of those markets. Fannie and Freddie get jumpy when they themselves or other lenders have a lot of exposure to a particular market. If they've underwritten too many deals in that one particular market, they'll put the city on what is called pre-review and then ultimately review, where they're basically saying we don't really want any more exposure to that city for whatever reason, and then their loan to value falls in that particular area and their rates will go up. So you will actually start to see less attractive loans in those markets for probably the next several years, maybe 2 years, 2.5 years, 3 years, somewhere around the range, 2 years or so. Local lending, bank of somewhere, right? That is largely going to depend on their balance sheet. Depends on how much office and multifamily they've gotten exposed to over this last year, 2 years, right? If they're not overexposed in those categories, then they'll probably stay strong as lenders. If they're heavily exposed in the multifamily and in the office space, they may be struggling with their own balance sheet. And remember, these lenders have to hold reserves, right? They have to hold a certain amount of cash in their own reserves to satisfy the FDIC and the government. So the riskier their lending gets, or the more out of whack their balance sheet gets due to the valuations of these assets falling, especially in office, then they're going to have to hold back more reserves, which means they lend less. So you can see a little bit of a doom loop going on there. I don't believe that we're going to see any major crash in our mid-tier banks. I do believe that you may see another failure or two. We'll see. The government's not really trying to make that happen, and lenders are not really trying to just come and scalp all their borrowers right now. So luckily, we have everybody kind of rowing the boat together, but you got to make sure that you're a good operator, make sure your stuff is in place, your operations are in place. So that's going to be a bit of a downside, is that lending is going to be tight in those markets. The upside is I think you're going to find a tremendous amount of deal flow in those particular areas, and that's going to be as these loans mature. It's going to force sellers to reset, either recapitalize, or have to, as I've said, consider selling. And that's where you might pick up some deals. But you're going to need other forms of financing, such as creative financing, right? Non-traditional financing, when the normal bank won't come in and get that deal done. So I think that those markets are core markets, right? They are excellent markets. They are major metros. They trend up and down, but at the core of it, they're still really big cities. Atlanta's known for boom and bust. That's my hometown, right? I'm from there. And it's known for that kind of overbuild and then crash in value and then rise and fall and rise and fall. It's known for that, but it's still Atlanta. As New York is still New York. What you want to do is wait for these major metros that are good core markets to have a sale and then go in there and stock up. And that's what I think we're going to see. Not this afternoon, but over the next year, over the next 2 years. I think these are going to be the absolute metros that you want to watch because of the short-term distress, but the long-term fundamental value of multifamily and the fundamental values of those large cities. They're not going anywhere. Dallas is not going anywhere. Atlanta's not going anywhere, right? Neither is New York. They're just going to cycle. So you want to time that. You want to watch that and get in there, get into those assets. Start, as I teach all my students and my clients, it's three things: deal flow, deal analysis, networking. Those are the three systems you got to have every single time, right? Deal flow, got to be bringing in the deals. That's working with realtors, going to owners, sourcing these assets on a very regular basis. Deal analysis, you know what the hell you're looking at, right? It's competency times frequency. And then you have to have the network to be able to take these deals down when a hot deal comes along, because trust me, they don't stay on the market long. All right, so that's what we're going to be looking at, I think, going forward. Again, those are your top major metros that have a massive amount of loan maturity coming due. There are a lot of other areas that definitely have different maturities and different things to that effect. But you're really going to want to focus on your operations going forward. It's going to be absolute key. On that note, also pay close attention to your management company and your own asset management skills. If you need help with some of that, certainly reach out to us. We can help you with that. But that's going to be the trick. And what I've noticed lately is there have been so many new management companies sort of form over the last 3-4 years that they came into the business when the business was kind of taking care of itself, right? They became property management companies when the leasing was easy, when staffing was easy, when everybody had money and you could just go out and double the rent and nobody would say anything about it, And now that the world is not so lenient and leasing is not so lenient, we're seeing a lot of management turnover, a lot of staffing turnover at property management companies, so that's been tough. Been going through a lot of that lately. Starting to see that sort of thing. So you're really what I was saying is basically these property management companies are too new. That's where I was going with that. Sorry. The property management companies are too new. They have not been in business long enough to be experienced as property management companies. And so they don't have their systems in place and they're having a lot of staffing turnover. So as asset managers, if you already own an asset, you've really got to focus on the property management company. Make sure you're getting the right property manager in there. If you are new and you have not purchased yet, make property management analysis a big aspect of your market analysis, right? Mistake I see a lot of people make. They go way out into little town somewhere in America and they buy a 10-unit apartment complex out there and forget, there's not any management options all the way out there. Or there may be one or two management companies. You burn through both of those because they both suck. Now what? You're going to go over there and manage the thing yourself. So I've dealt with a whole lot of that. So if you already own the asset, you're going to have to work with what you got there as far as management is concerned. If you are new to the business and you're looking to select a market, really take a look at who is operating in that particular market, how many companies there are, and check and see if you can get reviews. Ask around, ask other people, go to your local groups, ask who's good property management. There are a lot of cities I will not invest in strictly because the management options are not worth it. And then I know what that means. I get to go over there and be a landlord and sit in the office and collect rent and sign leases. Been there, done that. Not doing that anymore. I'm an investor now. I'm not a landlord, so I'm not going back to doing that. And I don't recommend that you do it either. So that's how you're going to have to kind of think about that going forward with markets. Really make sure you got good management there. And then as far as asset management, when you're looking at those markets, make sure that you can reasonably get there. Look at flights, look at connections, look at things like that. I see so many people wind up just picking markets all over the country, and then they're a pain in the butt to get there. And they wind up spending more time than they expected, going there and dealing with stuff. And it's all what we call tuition, right? You can pay that tuition in this class or you can pay it out there on the street. Totally your choice, but you're going to get an education and you're going to pay for it somewhere, somehow. So that's what I have for you today. 5 cities that we have coming up with major volume. We got Atlanta, Dallas, Denver, Houston, New York, and Chicago. Top 5 cities in a row that are having multifamily maturity between today and 29. I think these are going to be your top 5 cities you want to keep an eye on and certainly be looking for creative financing in those 5 cities. Bill Ham, realestateraw.com. I appreciate you all. Thanks for stopping by. Hey, thanks for checking out that video. If you'd like more information like this, or you'd like to find out how you can work with me directly, go to realestateraw.com or just click the link below.